On October 5th and October 6th, the last Thursday and Friday, Nifty has moved up by almost 1 percentage point.
19,677 is where we're shutting shop for the futures. A good 100-point uptake for the Nifty coming in.
Now, to understand why this rally has happened, we need to start with a simple example. Imagine Rahul is sitting in New York with $100 million of cash in his pocket. Well, what can he do with it? The option one is, of course, putting all the money under his mattress, but that doesn't let the money grow. So let's look at some realistic options. The first option being buying a bond issued by the US government and give that money as a loan to the government. This is considered to be the least risky asset class out there, and hence people would definitely go ahead and do it if the interest rates that they receive are high. And currently the interest rate is 4.7%, which is huge. The second option he has is go ahead and put that money in a fixed deposit or a savings account. The third option is go ahead and buy some equities on the stock market. Or fourth, lend that money to a startup, to a friend, to a business, whatever it is. His minimum expectation in every scenario right now would be, I need to make at least 4.7% return. Otherwise, there is no point in taking that risk. In technical terms, this is called as bond yield rate. But for simplicity's sake, we just will call it as interest rate. And what does this have to do with how Indian markets have performed well in the last 2 days? To start off with, whenever the bond yields, that the interest rates are increasing, there is always a confusion in the people's mind that, hey, should I just go ahead and buy a US government bond or should I invest in the stock market? Hence, if you look at these two charts in the last 1 month, as the bond yield rates have continued to increase, the Indian stock market has continued to decline. The foreign investors were moving out their money from the Indian market and buying bonds. But if you look at what happened in the last 2 days, the Thursday and Friday, 5th and 6th of October, you will notice that the bond prices are beginning to stabilize. They were between 4.6 and 4.7%. So the investors who were looking to bounce back, they got this opportunity and they just continued to gain in the stock markets. There was, however, another factor which was contributing to this particular small rally on 5th and 6th. That is the price of the crude oil. If you look at this particular chart, the price of crude oil from the past 1 month has been hovering around $90 to $94 per barrel. However, from October 3rd to October 4th and 5th, this particular price has dropped down by 5 to 6 percentage points. From $90 per barrel, it came down to almost $84, $85 per barrel. And once the oil prices come down, what happens? Of course, the consumption increases and the economic activity increases. So the thrust in stock markets will obviously increase. And hence, both these factors together have led to that small rally on October 5th and 6th, the Thursday and Friday. Then how does it look going into the next week or in the near future? The first point that we need to consider is the job market data that was released late night India hours on Friday is also very, very positive. There were close to 300,000 jobs that were added in the last month, which means the economic activity is pretty good.
It is, secondly, bad news for markets and for the Fed. The Fed is not going to welcome this report, which leads to my third issue, which is over the long term, this may end up being bad news for the economy as well.
The US government interest rates will continue to stay high, which means the bond prices have continued to increase once again. On just late night Friday, the bond prices have once again touched 4.8%. What does this mean? This is not a good sign for the Indian market. And again, not just for the Indian market, but for the overall world as well.
France is flatlining. Germany is the sick man of Europe. China is not growing.
This clearly indicates, again, not just India, but every other major nation is also struggling right now. And also now thinking about the way forward on the crude oil prices. India has got exclusive agreements with Iraq and Russia to get discounts on their oil purchases. These discounts would end by the end of this year. Once the discounts end, we as an oil dependent nation, we need to make sure that we are aggressive in buying. So any increase in crude oil prices will be a bad thing for Indian economy. And where will it be reflected? Once again, the stock prices. So looking at both these things, it is not looking a rosy picture. Well, we might see some small relief rallies like what happened on 5th and 6th of October, but the overall scenario is definitely not looking positive. Please understand that there is definitely some kind of technical information that you need to know, and there is some core microeconomic concepts that you need to understand before jumping and putting that money in the stock market. Just don't go ahead, put that money because some YouTuber is telling you to do that. Please do share this video with whoever needs to hear this point today. Thank you so much guys, and we'll see you again in the next one. Bye bye.